Welcome to Money Hangout once again. This is our weekly interaction with you where we try and answer some of your questions. Any investment issue that you will be anxious about, we try and address any of those issues. This is brought to you by Birla Sun Life Mutual Fund and Value Research. Today we are going to discuss about how to make your tax saving investments as you face the deadline. March 31st is the deadline for making that investment, but you have to make it earlier if you are working to report it to your payroll person so that he can account for it. It's just about 5 weeks now. And every year you get this privilege. Our tax laws provide that you can make some investment and that will be, they will qualify as eligible tax saving investment. And that could be, and the laws are very straightforward. All the eligible investments or some of the expenses that you can make, all that can be put together, and that is deducted up to a maximum of 1.5 lakh rupees and will be deducted from your income for computing taxes. So you can look at this privilege or this benefit as getting a cashback of 45,000 rupees, depending on which tax bracket you fall in. It's almost like if you make this 1.5 lakh rupee investment, this money works for you, and you get 45,000 rupee cashback because you will save this much of taxes. So this is something which I think everybody should avail to the maximum possible extent.
And in fact, it offers twin benefit, isn't it, Dhiren? So one is the immediate return in the form of low tax liability, but the fact that it opens up a long-term investment avenue, which over a period of time can account for a substantial wealth creation for an individual.
Absolutely, and that is the intent of the government. Government wants citizens to save for their future, and that is why they're incentivizing this behavior. Incentive works with human beings, and that is exactly what the intent here is. That and that is why you find that all tax saving investments, they come with a lock-in period, so that people don't save for the short run, but they save for the long run and for their own future. So that helps. That is actually the policy goal.
And how to go about it now, Dhiren? Then, given that the window available now is of just 5 weeks, so how can people configure their savings in this limited period of time to make the most out of the time left?
First and foremost, I would like to say that it is at all. In fact, last week I was quite surprised by, a doctorate who works in Delhi University, is a professor, and she checked with me that how to save on her taxes, and every year in March, she has to worry about it, and she's informed by her, the account person in her college that this much will be the tax deduction or whatever. When I explained her the whole thing, she was quite surprised. She was quite astonished that that this is all there to it. Is it this simple? So I think there is a lesson here that a lot of us we have not paid any attention to this. We think it is complicated. It is not complicated at all. It is very straightforward thing. Let me explain you just to summarize and recap. Whatever be your income, you can see, if you are investing in eligible investments or a set of investment up to 1.5 lakh rupees, that money will be deducted from your income for computing taxes. The eligible investments are, your provident fund contribution, or your PPF contribution, or your term insurance, premium, or your life insurance premium. And all these things, you add it up, and if they add up to 1.5 lakh rupee, you are done with it. If you are not through, if you are not up to 1.5 lakh rupee, and you are still you're likely to pay taxes, it makes sense to actually borrow money to make that investment, so that you can take the advantage to the hilt. And now let me just list some of the simple things which you can actually take credit for. Your EPF contribution, your PPF contribution if you have still not discontinued it, your ULIP contribution if you still have not discontinued it, and your term insurance policy premium that you pay, that can be added. And then all the home loan principal that you'll be paying in the financial year, This is also an eligible contribution, or it qualifies for this benefit. So you add them up, and if they add up to 1.5 lakh rupee, you are done with it. If it still does not add up, invest some more, invest the remaining money, whatever is the leftover, by adding this up, deducting it from 1.5 lakh rupee. That is your maximum eligible investment that you can make. And investing in a tax saving fund for now, generally I suggest that do your SIP in any equity investment. But maybe this year, as you are hitting a deadline, and if you have not done it, and the very normal human psychology to postpone our most of the things to a deadline or to the last minute, make that investment now. Anyway, I think if you are going to make an annual investment in a tax saving fund, that becomes your annual SIP rather than a monthly SIP, and you don't need to average it, and you are forced to hold it for 3 years. That makes it, that forces discipline in you.
How about NPS, Dhiren? There's lots of interest from our viewers in NPS, given that it extends the limit of or to avail tax exemption from rupees 1.5 lakh to 2 lakhs. What are some of its pros and cons, and would you recommend it to our viewers?
NPS is low cost, it is efficient, but there are certain advantages. By the very design of NPS, there are 3 things which I don't like. One is that it doesn't provide you flexibility. You have to necessarily hold it for till your retirement. 40% will be annuity, has to be converted into an annuity on your retirement. 60% you can take out, of which the 40% will be tax efficient, will be tax free, and 20% will be taxable. This is one. The other thing I don't like is the asset allocation. Such a long-term investment, and you have to hold it for the maximum investment that can go is in equity is only 50%. So this is not a very efficient asset allocation. Maybe in future it becomes more efficient. And the investor not being trusted that he will not be acting responsibly with his money. I think anybody making a deliberate choice, I think that over time, a lot of these people will be a conscious investor. They'll be aware of what they are doing. They will do the right thing with their money. So forcing something by design is what I dislike and is dislikable about. And of course, you get the extra 50,000 rupee investment made. You get an extra tax break. That is the most compelling one. But when I compare it with the alternatives, assuming that an investor has a choice of making 50,000 rupee investment in the NPS and get the tax break, or paying the tax of 15,000 rupee on your 50,000 rupee investment to be made in NPS, and you invest 35,000 rupee in equity. What are the advantages? You are at absolute liberty to do whatever you want to with your money. All your gains for holding above 1 year will be completely tax free. You will not be forced to buy any annuity, anything after this. So my sense is that somebody investing 35,000 rupee in an equity fund as compared to 50,000 rupee in an NPS, that 35,000 rupee investment made in equity fund over the next 15-20 years will be far more, with far superior flexibility and control in the hands of the investor as compared to NPS. So that is why I don't like it. I don't like any investment which has to be made just for the sake of taking the tax break.
Thank you, Dhiren. Now moving on to the questions coming from our viewers, let me start with some of the basic ones. Sanjeev asks, what is the difference between a normal mutual fund and an ELSS? And just to take that further, Ashutosh wants to know if one should invest in ELSS even if tax saving is not an objective.
There is only one difference between an ELSS and any other multi-cap equity fund or a similar fund of a similar equity fund of the same fund company, that your money is locked in for 3 years, and as a result of which, I think there will be a lot of some benefit which I hope the fund managers get. One is that the fund managers get a superior premise. So from an investor standpoint, there is only one difference, that your money gets locked in. You can't take your money out for next 3 years. Of course, the side effect of all this is that the fund manager will be able to think long term, because he will be assured that the money will, he doesn't have to bother about investors taking their money out immediately. He won't be under any constant redemption pressure in a bad weather. So those are the added advantages, but it has not translated into any statistical evidence that tax saving funds do better. In fact, tax saving funds, there is a possibility that, once a tax saving fund gets a lot of money and it can't get out, the fund manager just might be complacent.
So does that in a way, I think, answers the second question, which was if one should invest in ELSS if tax saving is not an objective. So
Yes, I would like to emphasize here that never never build any constraint for yourself unnecessarily. And following this principle, why you should get your money locked in when you don't have to? And there are and if you look at the choice, you have far too many other funds to choose from as compared to ELSS. So for the very reason of its lock-in, I would say that one should avoid it. One should keep the control in oneself. Of course, one should be a long-term investor. One should be a disciplined investor. One should be investing regularly to benefit from it, and one should be investing with confidence, with conviction, by choosing a good fund. But why why compromise on the liquidity at any time when it's not needed?
next up, Abhinay says that since the market seems to be on a peak, does it make sense to invest in ELSS through a lump sum, given that now very limited time is left in the current financial year?
Generally, my general advice is that when investing in equity, and when an individual investor is going to make an investment in equity of any kind, one should stagger one should spread one's investments over time. But you don't have much time, so maybe make 2-3 investments in this 5 weeks. Maybe do a weekly or alternate weeks, make 2-3 investments, and that is how you will be able to average, because the markets are very volatile. We saw that 1 week was down, 1 week was up, 1 week was down. But it doesn't matter when your holding period is 3 years and 5 years and more. These perfect timing, or attempt at perfect timing, it may not be very useful. I completely agree with you that if you are buying cheap, the potential of making larger gains is higher as compared to not buying cheap. And so from that standpoint, I would just like to urge him that there are two aspects to this. One is that the market is at its all-time high, but at the same time, but that may not be the only reason why you should not invest. There is a possibility that markets might be at an all-time high, but it may still be very cheap, because if the underlying stocks are not very expensive, if they are available at reasonable, if they are available at attractive price in relation to their earnings, markets can be at peak and they can still be cheap. But I feel that markets are reasonably priced. They might be even expensive in certain quarters, and unless we see that so there are two things: the markets at peak and markets being very expensive. I think markets are tending to be expensive and being reasonably priced. That is the impression I will go with right now. So be careful about that and be conscious of it.
Moving on, Mr. Chawla asks, is it okay to align long-term goals like child's education with ELSS, or one should look at them purely as better tax-saving tools? And then how should one plan to divest from ELSS?
It's a complex question, and I would just like to prioritize it. First, make your ELSS investment if you will get the tax break. No questions about it. Now, it is only a matter of mental accounting that you think that the ELS investment being made in ELSS is meant for your child, or meant for your retirement, or meant for your, some holiday which you have planned 10 years from now, 5 years from now. It is just a matter of doing a mental entry and anchoring your thought with that investment there. So keep these two things separate. My sense is that if an investor is not making any retirement savings, and if one is disciplined about in his working years, makes make full, or full avail this ATC advantage, this ATC break, and does that investment for 20 years, 30 years, it can well translate into a retirement corpus. This can be your retirement fund with all the advantages. Now, the third question is, should you sell your ELSS fund sometimes? You should sell your ELSS fund. If you have tagged these investments, if you have done your mental accounting with these investments as the fund for your child's education, or the fund for your retirement, or the fund for your down payment of the house that you plan to buy, if you you should be guided by this simple principle. The moment these investments accumulate to the amount that you can achieve, you have achieved your goal, go ahead and redeem your investments. Of course, it should be subject to the fact that the law that they are out of their lock-in period. Then comes, if the funds are really doing very poorly as compared to other funds consistently over a period of time, and that over a period of time I mean 2-3 years. 3 years is a lock-in period anyway, and after that, so if the 5-year return of this fund is worse than its benchmark and worse than its peers, if it is in the bottom quartile for on a 3-year return, on a 5-year return, sell your fund. If it is not, then stick to it. In fact, sometimes even if the fund is proving to be an average fund, but it has done well over a long period of time, might be you should stick to it. And if you are doing your annual investment in it, stick to it. So you should be selling your fund for 2 reasons: when you need the money, when your goals have been achieved, or the fund does poorly over a prolonged period of time.
Next up, Ravi asks if the dividends reinvested in his ELSS are also eligible for tax deductions.
Yes, they are, but it is no longer possible. In fact, last year, SEBI made a rule change that the ELSS cannot offer dividend reinvestment option in the ELSS. The reason was that when you invest in a ELSS fund, and if you choose the dividend reinvestment, then the units acquired on account of dividend reinvestment gets into perpetual lock-in period. The dividend paid by the fund will be the lock-in will be applied, and on those units the dividend paid once again will be the lock-in applied. So SEBI has made it mandatory that ELSS cannot provide you the option of dividend reinvestment in ELSS funds.
Moving on, Dhiren, Koel asks if there is any tax investment that does not have a time constraint. Time constraint as in any lock-in period.
No, there are certain expenditure. If you have spent some money on your child's education, child's education by way of tuition fee and two kids, you can do that. Your term insurance expenses, your premium paid, is the eligible thing. So they are expenditure. Not there. I can't think of any investment which is on which the lock-in period does not apply. In fact, on that front, the tax saving funds, I think the lock-in period on the ELSS should be longer. In fact, this is the shortest lock-in period possible, 3-year time frame. VF, it is 15 years. If you look at the bank deposit, it is 5 years. NFC, it is longer. So all other eligible tax saving investment, they are longer. The lock-in period is higher than the 3-year period, which is applicable on tax saving fund.
Next up, Balbir asks that he had invested under the Rajiv Gandhi Equity Savings Scheme. What should he do now in the wake of the announcements in this year's budget?
Look at it as a free investment, and if they are good funds, he should remain invested. If they are not proving to be good fund, get out of it. There is a possibility that money invested in Rajiv Gandhi RGESS, Rajiv Gandhi Equity Savings Scheme, in the past 2-3 years might be doing very well, because by the very design of it, they were supposed to invest in the large caps only, top 100 companies by capitalization, and large caps are getting back in favor. So some of those funds, some of those eligible investments might be doing reasonably well. So and if he's falling short of money to be invested in ATC, then he should redeem some of those investments and make that investment once again in ELSS and take the tax break.
Moving on, Sarthak says that he wasn't able to submit proofs of his ATC investments to his employer in time, which led to heavy deductions in his January salary. Now he asks, what can he do now?
He can't do much, but he should not give up hope. His money is not wasted. He will file his return, and all the investment that he has made, and in his return, as a result of this, he will be eligible for all the refunds. And today, the income tax department processes the refunds of an individual, assessees very efficiently. So he will get all his money back. And take a lesson that if you are able to file your information timely with your accounts people, then you can save yourself of this money going to the government and coming back to you again. It will not go to the government in the first place.
Next up, Sanjeev asks if one should invest in capital gain bonds or pay long-term capital gains against tax and invest the post-tax amount in MFs. So you provided our viewers your thoughts on investing 50,000 in NPS versus paying the tax and investing in equity. Would that hold true in this case as well, Dhiren?
Yes, I think that investors should pay long-term capital gains and be at absolute liberty to maximize or optimize the return on investment, because I generally avoid any investment to be made for the sake of constrained investment, and the tax saving bonds which are available, they yield very low returns, and they will be yielding even lower return, and and you get locked in for 5 years. So it is better to but do your estimation and decide based on your rules. But generally speaking, I will, if I have to take if I have no immediate plans with my money, if this is my long-term money and I have realized capital gains by selling a house, I would not like to get constrained with by putting my money in a capital gains bond which will be yielding 5.5 6%, yeah, or even lower.
Our next viewer, Shri Kalyan, asks if it is advisable to invest in mutual funds with AUM of greater than 10,000 crore. So is size a matter of concern, Dhiren?
Size is a matter of concern. Size many a times also gives advantage. It depends. If you are investing in a large cap fund, I don't think size is as much of a matter today, even if it is 10,000 crore, 15,000 crore, 20,000 crore, because the capitalization, the liquidity in those underlying companies is good enough to support a large size fund. If it is a liquid fund, I think the bigger the better. Large funds will be able to, provide you superior economies, lower expense, and they will also be more resilient. If they are faced with a calamity, they will be able to withstand better. When it comes to some other set of funds, the mid cap fund, the small cap funds, it could be quite difficult. It could be very challenging if they are crossing 2 3,000 crore asset base. They will, in fact, recently we came across this situation that the DSP BlackRock micro cap fund, it had to stop taking money because it finds it difficult to manage that fund. So some funds might be under some disadvantage if they get bigger, and the ones which are likely to get hugely disadvantaged are the small caps and the mid caps when they turn big. So be wary of that. But I think the multi caps and the large caps, if they are 10,000, 15,000, 20,000 crore, I don't think it is as much of a concern today.
George, who is an NRI, asks if tax-free NRE fixed deposits are better than debt funds for NRIs.
They are, it might be a little better off, because looking at what a short-term fund will return, will get you on a 3-year holding period. Uh, your tax liability will be the appreciation, less capital gains, less, and it will your capital gains will be indexed, and so effectively, the effective tax rate on the gains might be less than 10% after indexation. So if the returns there could be 8%, and if your effective tax rate on the appreciation is less than 10%, then it just might be better. You might be better off, but you don't get the guarantee of guaranteed returns in a mutual fund. So in terms of simplicity and in terms of guarantee and efficiency, the differential will not be very much. 7.5, 7.2, somewhere between 7 to 7.5% in a mutual fund post tax, as compared to 6.5% in a tax-free bond, a tax-free deposit. You have to see that uh, is it a good enough 20% more return in a mutual fund? Is it a worthwhile premium for the lack of getting a guaranteed return?
Moving on, Dhiren, Manik asks, how is income tax calculated for share buybacks? Is it similar to how long-term and short-term capital gains are taxed on sale of shares?
Yes, nowadays I'm told that most of the buybacks happen through the stock exchange mechanism. So companies you don't tender your shares back to the companies directly. What happens is companies place an order through the stock exchange, so you end up paying the securities transaction tax. For an investor, his share buyback is like selling his shares in the market, and the moment you pay STT, securities transaction tax, on your sale, it is treated as long-term capital gains, or the normal capital gains rules apply. Only in cases when I'm transferring my asset to my father, or somebody in my family, or I'm not going through the stock exchange for the transfer or acquisition of any share, is that I don't get that benefit. So here, if you're doing this, as the share stock market mechanism is, or the route is taken for this sale, so you are eligible for all the you're entitled for all the benefits.
We have time for just one last question, Dhiren. Mr. Wankhede asks if an MF is better than an ETF, and what is the tax treatment of an ETF?
Tax treatment of an ETF is the same as mutual fund. You hold, because depending on if the ETF is based on equity, it is entirely a function of what kind of underlying investment is. If you're talking of a gold ETF or a fixed income ETF, then it's not. But all other equity ETFs and the equity fund, that they are treated as same. The key difference is that all ETFs are mounted on an index, and mounted on an index, so you have to choose between, you have to make a choice that whether you want your money to be managed actively, or you want to ride an index, you want to generate as much return as an index. So uh, and in India, the case for actively managed fund is very compelling on any 5-year, 10-year period, or for an SIP. Uh, the actively managed funds have been able to deliver superior return. Uh, Variety of reasons for that, uh, and we will go deeper into those issues in some special hangout session. But the case for ETF has not been very strong, simply because the fund managers have been able to beat the benchmark by a wide margin over any long-term period. And buying the ETF as compared to an open-end fund is little complicated. The way you buy a mutual fund is you go to a stock, you buy it directly from the fund company, or you buy it through mutual fund utility, or you buy it through a mutual fund agent, or you buy it from your bank. Compared to that, you go to your stockbroker, you buy ETFs the way you buy shares. You place your order, you don't get it at NAV, you get it at the market price, which might vary from the NAV on a day-to-day basis. Sometimes it can be at a premium, or sometimes it can be at a discount to their NAV.
Thanks, Dhiren. Any closing remarks for our viewers?
Yes, don't leave your 80C entitlement of any kind. If you are left with 10,000 rupee leftover entitlement, make that investment. Tax saves is money earned.
Thank you, Dhiren.
Thank
Thanks
you.
everyone for joining in.